America's triple threat: debt, interest rates, and sticky inflation. Why it matters to your wallet. The U.S. Treasury's ledger now shows a gross debt well above $35 trillion, roughly $105,000 per citizen. That mountain has more than doubled since the 2008 crisis, outpacing both population growth and national income. A larger balance means heavier interest charges and a higher likelihood of future tax hikes or program cuts, costs that ultimately flow down to household budgets. Interest payments closing in on the $1 trillion mark. Net interest outlays are the fastest growing line in Washington's budget, projected to flirt with $1 trillion this fiscal year, more than Medicaid and nearly the size of the Pentagon's payroll. When Uncle Sam's interest bill grows, every other priority, defense, highways, tax relief, competes for leftovers. Less fiscal room equals fewer services or higher taxes for families. Yield curve inversion hits the 20-month milestone. Short-term Treasury yields have exceeded long-term yields for nearly 2 years, a pattern that has preceded every post-war recession except one. An inverted curve signals that creditors expect slower growth ahead. For consumers, that could translate into layoffs, smaller raises, and a more cautious lending environment. Real yields return to pre-2008 highs. Inflation-protected bonds, TIPS, now deliver about 2% above inflation, levels unseen since before the Great Recession. Rising, real yields push borrowing costs higher across mortgages, auto loans, and business credit. Higher real yields reward savers, but they also raise monthly payments on variable rate debt, pressuring cash flow for households with credit card balances or adjustable rate mortgages. Sticky services inflation persists above 4%. While gasoline and grocery prices have cooled, rent, insurance, childcare, and medical services continue climbing at 4 to 5% annually, well above the Fed's 2% target. Because services dominate family budgets, overall purchasing power still erodes. Wage gains must clear a higher hurdle just to keep living standards flat. Credit card rates break the 22% barrier. The average variable credit card APR recently crossed 22%, the steepest reading on record. Banks price cards off the Fed's short-term rate plus a risk premium. Carrying a balance for just 12 months at that rate devours almost a quarter of every dollar you owe, making debt repayment and wealth building dramatically harder. Mortgage affordability falls to 1980s levels. 30-year fixed mortgage rates hovering near 7% have pushed the typical mortgage payment to more than 35% of median household income, a ratio last seen in the early 1980s. First-time buyers are priced out or forced into smaller homes, delaying wealth accumulation tied to housing equity and raising long-term rent exposure. Corporate refinancing wall looms 2026 to 28. Over $2 trillion in investment-grade and high-yield corporate bonds mature within 3 years. Many firms issued cheap debt in 2020-21 that will soon reset at double today's coupons. If refinancing bites into profits, companies may trim payrolls or investment plans, affecting job security, wage growth, and the value of retirement portfolios heavy in corporate bonds or equities. Small business loan costs spike into double digits. Community bank term loans that once came at 5% now range from 8 to 12%, with SBA-backed lines even higher for riskier borrowers. Higher financing costs curb expansion, hiring, and local pay raises, weakening Main Street economic engines that employ nearly half of U.S. workers. The Fed's shrinking balance sheet tightens liquidity. Quantitative tightening has trimmed the Fed's bond holdings by nearly $1 trillion since mid-2022, reducing the pool of bank reserves and nudging up short-term funding rates. Tighter liquidity makes auto loans, personal lines, and even student loan refinancing more expensive, adding friction to everyday financial decisions. State and local budgets feel the squeeze. Higher municipal bond yields force states and cities to allot more revenue to interest instead of potholes, police, or teacher salaries. Expect pressures for local tax hikes or fee increases, property, sales, or utility bills, showing how federal rate shifts trickle down to the neighborhood level. Public sector pensions ratchet return assumptions higher. Many pension funds have raised assumed returns from 6.5 to 7%, betting that higher yields will close funding gaps. If markets underdeliver, liabilities balloon. Taxpayers and public employees foot the bill for any shortfall, through higher contributions or reduced benefits, affecting take-home pay and retirement security. International reserve diversification picks up steam. Emerging market central banks are slowly trimming dollar holdings in favor of gold, yuan, and other currencies, citing U.S. debt trajectory and sanctions risk. A weaker global appetite for treasuries could translate into higher borrowing costs at home, reverberating through mortgage and credit card rates. Savers face the real return tug of war. Bank CDs finally pay north of 4%, yet headline inflation near 3% erodes half of that gain, leaving savers with modest real growth. To outpace inflation sustainably, households must diversify, balancing cash with inflation-resistant assets like dividend stocks, tips, or select real estate. Generational wealth gap widens under fiscal strain. Young households inherit not only soaring tuition and housing costs but also a larger public debt burden that threatens future tax rates and benefit cuts. Older cohorts with fixed-rate mortgages and legacy pensions are relatively insulated, amplifying an already wide wealth divide and reshaping politics around taxation and entitlement reform. Something to think about. Debt is the powder keg, rising rates are the lit fuse, and sticky inflation is the smoke already curling under the door. You can't blow out this fire with wishful thinking, but you can fire-proof your finances. Audit every dollar, lock in fixed rates where you can, build cash buffers for the storms, and own assets that outrun inflation instead of chasing it. The next decade will punish the unprepared and reward the disciplined, so tighten your financial armor now, because prosperity isn't promised, it's protected.